Thank you. So in this webinar, we want to kind of continue on what we built on last time. So looking at some how derivatives work, how to trade them, etc. So a particular subject I want to discuss today is about futures prices and spot prices, and looking at the spreads between different futures prices along for any individual asset. So, for example, if you were to look at crude oil, you would see that there's a price for the March future, there's a different price for the April future, there's a different price for the May, June, July, etc. So why is this the case? Why do we have different prices for different months? What does that mean? And can we use that to make profitable trades? So let's start with a few definitions. So spot price. A spot price is the price of something today. So what it's trading on the market today. And this is something, for example, that as an investor, if you were investing in commodities, you would not ever be able to buy something on a spot market, because then you would actually have to take delivery of the commodity. So we generally only deal in futures, but as I'm sure you would be aware, the futures price and the spot price are very closely related. So the futures price is then the price of that commodity at some date in the future, and then you have different futures for different dates. And the difference between those prices for each month is called the spread, and the term structure is then what the entire curve looks like of all the different futures at all different times. So you might have, for example, an upward sloping term structure, which means that futures prices are rising over time, so that the far futures are more expensive than the near ones. Or you might have a downward sloping term structure. And we'll go into a bit of detail on what each of these two things mean. Now, crucially, what's quite important is that the futures prices are a reflection of what the market expects the price to be in the future. So, for example, if you wanted to buy a commodity today, you might see that the futures price for the near month is much cheaper than the futures price 1 year from now. And so in that sense, the market is already pricing in a significant increase over the year. So that's what that means. So I want to discuss futures spreads in the context of currencies and commodities, because they are both a bit different in terms of what they mean. And hopefully they should provide us some greater insight into how these things work and how we can trade them better.